Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, we are going to talk. We've been talking a lot about mortgage rates. And the reason we have is because over the last 8 weeks, mortgage rates have had the largest decline in over the shortest period of time as they have in the last 14 years.
Right.
Okay, so there's this company called Fundstrat. They are a global research firm.
Mm-hmm.
And they did something super famous at the beginning of this year when everyone was predicting things. What did they predict?
So everybody else was predicting all kinds of chaos, and they predicted not so much chaos. They actually predicted, was it the
S&P 500.
S&P 500 within 4 points.
4 points. They were actually one of the highest, and they nailed it. And they also just recently, actually today, they made another prediction about mortgage rates.
Right.
Okay, so we're going to talk about those because they're on a track record. Okay, so here's the article: mortgage rates could fall below 5% next year. Okay, emboldening U.S. consumers, allowing banks to reliquify. Fundstrat's Tom Lee says. Now, how was it that they? So the way they did this was because they didn't think inflation would stick around. They thought inflation would drop pretty quickly, and then we could get back to normal, right?
Well, they thought the Fed would take aggressive action, and that it would work, and that inflation would be brought under control relatively quickly, and we would all be able to get on with our lives, which is sort of what's been happening, right?
Yeah, it has been. And so here's the first quote from the article. Mortgage rates could fall as low as 4.75% next year, according to Fundstrat's Tom Lee. This is actually interesting. If mortgage rates go to 4.75%, then those 10 to 15% of the people who have 5% rates or higher would probably all rush to refi. Do you think they would try to lock in a lower rate?
Yeah, I mean, I think you're going to see what you saw kind of during the pandemic, the serial refinancers.
Right.
I think you're going to see that. I think for every point and a quarter that rates go down, people are going to rush back out and do it again because they still have PTSD from the 8% that was just briefly this fall. So I think that they're going to refinance as early and as often as they can to get to whatever magic rate that is for them.
Typically you don't want to just keep refining every time rates drop a little bit because there's a cost.
Right.
You have to pay to refi. There's usually some upfront cost. A lot of times you don't actually pay it like cash up front. Sometimes you just get refied into the loan. Right,
but that's still a cost. I mean, that's still increasing the balance of your loan.
Because it pushes up the balance of your loan, and the lenders will go, oh, hey, yeah, you don't have to do anything out of pocket. Your mortgage payment will drop. The problem is there's always this break even. It's a time frame break even. Why is that for refinancing? Right,
because most of us don't hang on to our homes until the maturity of the loan. So because of that, there is this sweet spot, right? That if you're going to be in the house for 5 to 7 years, it's worth refinancing. If within a certain range, if you're going to only be in the house for 3 to 5 years, then the drop in interest rate has to be more significant. So it depends on how you're going to keep that loan for. It also makes a difference for people who maybe switch from a 30-year to a 15-year. So there are all kinds of things that you kind of have to calculate. My position is, as you guys know, put pencil to paper and figure out what your sweet spot is, what makes sense for you, because everyone's situation is different. I mean, it depends on your age, it depends on your job situation, your financial situation, maybe the age of your children, maybe all kinds of other things. Maybe you might have elderly parents that need to move in and you've got a 2-story, so maybe you're not going to be here that long. All kinds of things that are going on there. So everybody's situation is different. So it makes sense to really kind of figure out what makes the most financial benefit for you and what that difference in rate drop is versus the cost.
Another quote from the article. Markets are expecting the Fed to cut interest rates next year, which would lower home borrowing costs. Now, these rates we've seen drop over the last 8 weeks. The Fed hasn't changed its federal funds rate, which is the rate that the Federal Reserve charges for overnight bank loans.
Right. This is anticipatory.
Right. This is the market. This is the 10-year Treasury and what people believe 10-year money is worth. Because mortgage rates, so let's talk about this really quick. This is sort of a like teaching moment. If you have a 30-year mortgage that's amortized over 30 years, why don't we use the 30-year bond as the benchmark for what mortgage rate should be?
Because people don't keep mortgages for 30 years. They keep them for about 10 years.
Okay, so guys, write this down, okay? The 30-year loan, no one ever expects you to keep that loan for 30. I'd be shocked if anyone kept the same loan for 30 years.
Right.
Two things happen.
So even if you're in the house for the 30 years, a couple of things are going to happen. Either you're going to refinance, right? Or you're going to pay off the mortgage early. So there are three options: refinance, pay the mortgage off early, or take it to the full 30-year maturity. So because of the three options, well, of course, you could sell the property and then the whole thing goes away anyway.
Yep.
So really, there are four options. So because of those four options, very few people make it to that third option or that fourth option of keeping the loan the full 30 years that they started with.
Right, exactly, yeah. So in average, people tend to move, at least in the past, it was every 10 years. That it was at one point it was 7 years.
Mm-hmm.
In the 20 years ago, people moved every 7 years on average, right?
Mm-hmm.
It's over 10 now. I think it's
Right.
12. This number is going to just keep growing every year, probably because so many people are locked in and they're not going to sell the homes because they have such cheap money. So you really have all these, the 10-year money is really what mortgage rates are based on. Mm-hmm. It's
Right.
really the median. I mean, because like Wanda said, you sell the property, that extinguishes the loan. You refi, that extinguishes the loan, mm-hmm. right? You pay it off, that extinguishes the loan.
Right.
Okay. But almost nobody keeps the same loan for 30 years.
Right.
Right.
Well, because remember, the markets change, right? So if you have a loan on the house, and even if you're not moving, if interest rates drop substantially, you're going to refinance. And maybe you're going to refinance to a 15-year or just to a lower rate, whatever works for you. So there are all kinds of things going on in there.
I think the 70% of people who have 4% and lower rates probably never refinance. But they still either will sell the house or extinguish the loan some other way.
Right. Like
they'll move and sell the house. Okay. Here's another quote. In the interview with CNBC on Wednesday, Lee predicted mortgage rates could fall to around 4.7 to 5.2% next year. That's the 30-year fixed rates currently around 6.95 according to Freddie Mac, which is down from a high of around 8%. Mm-hmm. And I'm going to put up this chart in a second. I have a great chart. Okay, here's the chart. All right, so remember, this is the chart we showed you the other day. Okay, now what this chart is this is today's mortgage rates. Now, what I want you to consider is you see the 30-year fixed, 6.25, which is literally what it is today. It's actually, it's dropped substantially. 6.6 was the Freddie rate, okay? That's a rate for that is FHFA controlled. Mm-hmm. But look at the difference in a 15-year fixed, and then go to the bottom for a FHA, which is a lot less, and then in 30-year VA, which is a lot less too. It's like almost 0.7%. So if you get interest rates into the high fours, you're potentially looking at a 4% 30-year VA, mm-hmm. which is substantial. That's only veterans can get that. But then a 30-year FHA is probably going to be 4.2, 4.3%, mm-hmm. which is pretty darn low historically. One of these rates that they're talking about, how do they compare historically? Because now we're saying those are super low rates, but how does 5% compare to 2011 to 2019?
Well, I think it's on par with most of that time period. Those were pretty standard rates.
Okay. Yeah, I think so. I think that's probably even on the high side. I think most of the people that were buying houses during that time were getting 4 something mm-hmm. or high 3s. The pandemic and the 2 years that followed that, clearly people were getting under 3. Mm-hmm. A lot of people were getting under 3. A lot of people didn't refi their 5% loans because they were like, oh, it's only 1%, whatever. Mm-hmm. But I know some people that the best I heard of somebody I know got a 1.9%.
Right, and I've seen a sub 1% loan out there. But the point is that all these people that have 6, 7, or almost 8% loans, they're going to be refinancing as soon as these rates go down. And I think you're already seeing some refinancing activity. So I think lenders are going to be very happy with 2024.
Still falling rates are likely to jumpstart home sales activity. Real estate economists say after high rates sideline prospective home buyers from the markets for most of the past year, and that could end up being a boon for lenders and corporate earnings overall, Lee said. Clearly, but what's going to happen to home prices if mortgage rates tank but we don't get more homes on the market?
Well, so if mortgage rates go down and the supply does not increase, which there's no reason we would believe that the supply would substantially increase to keep up with the demand, then we're going to see multiple offers. We're going to see home prices go up. We're going to see people having to offer overappraised value. So it's going to be a flurry of activity this spring. It's going to be a lot of anxiety for buyers this spring because they're going to have to put their best foot forward and a lot of cash forward in order to get the deal closed.
Okay. So now we're going to look at what a couple other estimates that are not necessarily quite as robust. For mortgage rates to home sales, here are Fannie Mae's housing market forecasts for the next 2 years. So what they're saying is, while the shift in monetary policy spurred a sharp drop mortgage rates this quarter, Fannie Mae noted a limit to how far these rates will fall. It projects the 30-year fix will average 6.7 in 2024, which is basically where it is now, and 6.2% in 2025. So that's a very extremely conservative estimate.
Well, they're assuming no movement in the market, and the market's good at a lot of things, but standing still isn't one of them.
Okay, right. But although prices are set to keep growing, Fannie Mae doesn't expect 2023's momentum to carry over into the coming years. In this latest quarterly survey gathered in October, respondents saw home price growth reaching 2.4% and 2.7% in 2024 and 2025 after surging an estimated 5.9% this year. So this kind of surprises me. Rates this year were in the 7 range for most of the year, and we still had 5.9% growth. So if rates drop into the low 6s, we're only going to have 2.4, 2.7. I don't know, maybe.
The logic escapes me.
Okay. Here's another one. This is more in line with the first prediction. Mortgage rates could drop below 5% next year if inflation continues on its current path, which is declining, according to this Mortgage News Daily exec. And here is a quote from the article. There are some caveats, though. For one, Graham mentioned that if there was a recession next year, then that could move mortgage rates even further below 5%. He stressed, however, it really depended on economic data, chiefly inflation, getting to the 2% target. So in inflation, some people lose jobs, but probably only 2% of people, right?
You're talking about recession?
I'm sorry, recession.
Okay.
Recession, 2% of people lose jobs, but then the 98% of people who have jobs all get to benefit from the interest rates, which will rapidly be dropping.
Right. So, it doesn't mean that necessarily everybody runs out there and buys a house. It does mean that people refinance and have more money to spend in the economy. While people may have more trepidation about being able to keep their job because their neighbor lost their job, that's all very real. However, like I said, people will have more money in their pockets if they refinance. As far as homes are concerned, we know from history that home prices tend to go up during recessions, not down. And part of the reason for that is because we tend to have lower interest rates during recessions, which again spurs on home buying.
The only real risk in housing is overbuilding, right?
Right. Which right now it's not on the horizon. While home builders have pulled more permits in the last 30 to 60 days, it's still so far below what our needs are that there's not concern for that at this point.
Yeah. This company that gave this report, what are they called? Fitch?
I think so.
Fundstrat.
Fundstrat, yes.
Fundstrat right now has basically blown up all the housing crashers predictions of interest rates crashing in the housing market. I think what's interesting about this is that, interest rates go below 5%, we get a refi boom. And then that takes out all the 6 and 7% loans that are out there, which are only 5% of all the loans.
Right. So it does that, but it does something else too. By lowering people's payments, it puts more money in their pockets, and it enables people to start accumulating money again. And some of them will use that accumulation of money to go out and buy investment properties.
Right. Yeah.
So remember, real estate is like any other investment vehicle. Just the same way you buy index funds or stocks or bonds or whatever it is that you're buying out there, real estate is just another investment vehicle. And when people have money that they're saving up for something. Sometimes they're saving up for something consumable like a vacation. Sometimes they're saving up for a durable good like a car. And sometimes they're saving up for an investment.
Yeah. I don't know if this prediction is accurate, but these guys did nail what the S&P would finish the year at, 4750. It's at 4754 right now. They said it would be at 5200. I mean, that's a oddly round number, right? But they did nail it this year. Almost everybody else was predicting worse for the S&P. Their analysis was strictly based on us getting through inflation, interest rates rises, increases by the Fed stopping and then starting to decline, the market reacting to that. So it kind of, everyone was predicting this hard landing. They said, no, we don't see that. Because they really said it's all inflation. If you take out energy, was basically real estate and automobile. And that's been stomped out because the interest rates and mortgage rates going up stomped out real estate, 20% a year home prices going up.
Right.
Yeah.
Right. So anything else?
No.
Okay. Was it interesting? Merry Christmas. It's Christmas Eve. So we hope that you've been good and that you don't get a lump of coal in your stocking.
Yep.
So remember to like the video. Like it. Subscribe. Hit the notification bell. And Merry Christmas. We'll see you on the next video. Bye.
Bye. Merry Christmas.